S&P breaks above that critical level of April 9th. The VIX is now solidly below 30, closing below 25 for the first time in months. What the S&P NASDAQ relationship is telling us as we're forming this head and shoulders. You'd be surprised by this. Talk of the Zweig breath thrust and what it means. My opinion of this, we're going to get into some great detail today on it. Did it make it? Did it not make it? And the better question is, does it really matter? Uranium. Is this the time to start looking at uranium again? There's some signs here clearly that the answer is yes. AI data centers, are they dead? Are they not? Earnings this week are telling us clearly that there is a theme, and that theme is not going away. We're going to dive into this and what to look for this week coming up. What Tesla's above average volume and clear breakout is telling us about the market. 27.5% of you listening right now do not subscribe to this channel. All these videos are linked. I would strongly suggest that you subscribe and click all notifications. This is you. This is the guy she's talking to. Let's do it. Hey everybody, welcome back. A lot to cover here, so we're going to jump right into it. Let's get rid of Nancy and Warren. The most important thing for me this week is twofold. Number one, where I would start is just the VWAP. And the fact that we've only had one close under this VWAP since it was formed, which is our low. We can obviously see the day of liberation from the liberation that we were given earlier. And we can see how that marked that bottom right here. Work with me, not against me. And so once we're seeing there, we can see that break. And this is your first close on the futures above that. It's a big deal to me. It's a big deal. I like the close. Bear market rally, bull market rally, blueberry, strawberry. It doesn't really matter to me. Call it whatever you want. What I would call it is, this was our 50% demarcation line. These are fib levels. And what I'm more focused on here is that 50% demarcation, which is not a fib level. And you can see that we are clearly over something that we have not been before. We did it on huge volume with huge breadth, which we're going to talk about. But that would be my focal point. The second thing that I would take apart from this, we're going to clean all that off and we're just going to drop it like it's hot right here for a second, would be this line. And this is the line that we've been having and struggling with. And I think it's important to note that's not the high. The high is back here. And so you were a little higher over here than we were here. And we talked about this way back in the day when we were up in this area. And we were talking about the RSI, and people are like, RSI doesn't work, and they show them this graph once again and say nothing. But what we're looking at here and what's important about this is the following. You still have to get through this. You're making progress, and you're making progress in a lot of different ways. Number one, the RSI breakout was pretty darn clear, and you started having that on Wednesday and Thursday. So RSI, the way that I like to use it, is a leading indicator. Does it always work? No. The only thing that always works is gravity, but it does work. And what you're seeing here is when you start seeing something like the RSI breakout, and you'll note that my levels are different than if you're looking at like regular RSI. And if you're watching the videos, you know. But anyway, so if you look at how this is going, and you're watching these kinds of breaks, it's definitely important that it just smooths it out. I use open, high, low, close, 15 versus 14 close for those that are going to ask in the comments. You can always comment below and I'll share anything. But this is really important to me because it gave us structure. And it gave us more structure than doing something silly than sitting here looking at a 5-day moving average, which would have done nothing but got you chopped up this entire time. If you're buying all these breaks and you're not buying the pullbacks, buying the breaks, and you're not buying the pullbacks. You want to buy the pullbacks when this is happening in this kind of market. I cannot stress that enough. The tools that you used when the market was going higher in a trending market do not work the same way in a trendless market. Just the way it is, guys. I don't make the rules. What I'd be more focused on is support and resistance lines and then watching how we act at those levels. And we're at a significant one here that we're going to have to pay a lot of attention to, aren't we? So we will pay attention to this level and we'll go from there. I want to point two things out that I use at bottoms. Rate of change. Rate of change negative is always an issue, and flipping to that zero line is always optimal. And we haven't done it yet, but you're starting to. This is on a weekly chart. What I want to point out is that the rate of change hit an extreme level back here in October 22, and that rate of change led to what? That rate of change led to a bottom here where we rallied, and then here, which was the final bottom, final boss level, and then we went from there. Could we rally and retest? Of course you could, but this is the hand that we're dealt. What I like about this on the daily is that ever since we broke out from this level, we've just been going higher and higher on the rate of change. And you can see those movements, the retest of that zero line, and going for this is one of those things I really like using more at the bottoming formation, kind of like MACD at the more bottoming formation than now. If we go and take a look at the VIX, which I think is very important, let's get rid of the cat's pajamas. The fact that the complete collapse under 30 and now you're below 25 is exactly what you want to see. Where you would see an issue, usually on the VIX, is when you get back to where you were before, because what people will say is, I want to buy protection there. And why would they say that? They say that for a couple reasons. The biggest reason you would do that is, you know all this now, all that data, and now you're at the same level. So if I don't have the same amount of risk here that I had here, therefore, when I get to here, it's cheaper for me to buy protection. So this is usually where you'll see some kind of sell-off in the market. So you'd want to watch that 20.5, 21 area in here for maybe some consolidation and pullback. If we take a look at the S&P divided by the NASDAQ before we get into the meat of this, we need to look at smart money, dumb money, because it's really very clear how this is affecting the market. And the Zweig breadth indicator, when we get into this data, that's absolutely fascinating. When you get into that, it really tells you how this is playing out. I see left head, right shoulder, neckline break. If you go back further in this, you'll see that you've gotten to this level repeatedly, and then you reject. We'll go to the 4 hour on it, and we'll see this going all the way back to the pandemic. And those areas of interest where we get to here, this becomes an area where you could have support or resistance. I personally think at this time and place, because it's all relative, this is going to become resistance. And of course, you can see the breakouts here when the market was falling apart. If you look at this historically over time, this is what you've gotten since the pandemic, and it is that area of interest where you're getting that battleground. But drop it down here on a much shorter time frame, and you can just see the complete utter implosion of the S&P versus the NASDAQ, which leads us more towards time to start buying high beta again. That's what this is telling us. So we either listen to it or we don't. The choice is ours. I do find it interesting that the bond market is starting to come in. That 450 sale to that 4.25, the bond market's starting to believe what's being said out there because treasuries are being bought. And you could say, well, that's not the case. All you have to do is go and click on this thing called MOVE. And MOVE is bond option volatility. Bond option volatility is something that's going to be very interesting to you. Why? Because that's them buying puts on their bonds. They're not buying puts on their bonds, then they don't think bonds are at risk. They buy puts on their bonds when you're going into recession or there's a systemic risk to the market. A systemic risk to the market might be, I don't know, a president saying he's going to fire the head of the FOMC. That might be a systemic risk to the market. Or, $1 bazillion in tariffs every time a cup of coffee comes into this country. That might be an issue. And I'm doing hyperbole on purpose. But obviously, there are changes coming to policy, whether you agree with some of them or don't agree with some of them, nobody cares. What matters is how does it affect the market and how do we profit from it? Bottom line, they're risking less on what? That means if you're risking less on insurance, you're risking more on the upside of your bond portfolio, which means risk on. You'll hear that term a lot coming up in the future. Now, Tesla's move on Friday was telling, and what I would do before we get in any further is I would go and mark every chart that you're looking at April 9th and go from there. They're the ones you want to focus on. We're going to go through this at the end, and I'm going to give you 3 or 4 different areas that I'm looking at. And before we go any further, understand that earnings towards AI data centers, you can go and read Now's report and listen to these conference calls, and I would suggest that you do it, and you'll get a real clear indication of what's happening with AI data centers and why the fact that people think this is dead is delusional. And this, in and of itself, presents a great opportunity. We'll get into that. I do think we also need to look at uranium and what's happening here. You're going to need something to power all this. You are seeing movement in this area. We're going to tie this to the AI data center move in a little bit. But first, we need to dive into smart money, dumb money, and what's going on with the Zweig breadth thrust, and why do you even care? Now, in front of us is smart money, dumb money. And of course, if you've been here for some time, you know that we don't refer to that. We refer this as smart to institutions and dumb as to retail. And I know if you've been here for a while, you've heard this before, but for those that are new, welcome. The reason for this is because smart money is calculated using institutional order flow. Dumb money is calculated using retail order flow. Why this distinction is important is because smart and dumb move differently. Dumb moves fast, up or down. It doesn't matter. Where smart tends to go on a more gradual 45-degree angle when they move. This becomes increasingly clear to us when we look at stuff like the smart money or institutional money and we note how it moves versus when retail wants to get in, how it moves. We can see that trajectory pretty darn quick. We can see how they get into things and how we get out of things. It's very, very different. They take their time where we can just see them, meaning retail, just us, as I refer to myself as retail, you can just see us panic. Now, there are developments here that we've been talking about for some time, and I think they're pertinent, so we're just going to discuss them very briefly before we move into the trigger that happened. What we've always noticed is that institutions and retail, the spread is important, but so are the parts of it, and looking at what those individuals are doing. And there's a reason for that. There's a reason why something here, for example, would help you call a bottom, even though you'd be like, well, how could that do it? We would note that because institutions, or smart money as it's referred to here, are full. Their bellies are full, because this is your line that's telling you that you are overbought, for lack of a better term, meaning they are full. And we know when they're full, what do? They take their time getting out, don't they? And what does retail do? Get in, I gotta get in now. And that's retail. So if their bellies are full and they're hungry, what happens? You have an issue where you have a supply issue, and that creates demand. That demand could take time, and that's what we're always looking for. We're looking for those anomalies. So when you look at this chart and you think about it as institutions are full of stock, and again, it doesn't have to be oversold as much as when they're overbought, or again, bellies are full and retail's not. Well, you're noticing something here, hopefully by looking at this chart. Whereas if retail is full and institutions are not, retail's just going to puke it out, as we know. And institutions will be like, we're going to take our time. And that happens until there's a level or an equilibrium. And that equilibrium can happen. And we've talked about these crosses in the past. The great thing about these crosses are, now that you know the way that I explained it, is if retail's buying and institutions have some supply still out there, because they still obviously have some supply out there, right? I mean, you're not up here, but there's some supply. Look at what's happening. So they're selling their supply and it doesn't matter. Why? Because retail's going to buy that supply faster than institutions can sell it. That's why. And that, of course, can also create a bottom. What do we have going on here is the mother of all of these that we've seen in the past 3 years. Look where we're at on an institutional order flow base. Look at where we are with retail. And look at how retail's having their, oh boy, I might have made a boo-boo moment, for lack of a better term. Again, this is not my chart. This is Sentiment Trader. I'm going to cover a lot of their stuff today. I have no affiliation with them at all, but there's a lot of really good stuff in here, and it's worth us covering today. I do think that this is significant, and I do think that we should be paying attention to it. And we've got a trigger right here, and we're going to break this out where we're just looking at dumb money for a second. But let's dive into this a little bit more. So the important thing about doing all this and why it's so important to get these kinds of moves, it's important to get these kinds of moves and understand what you're really looking at. So instead of you just saying smart money, dumb money, when you understand how this is actually calculated, which I won't bore you with, you start to go, oh, okay, well, this is important and I want to pay attention to it. For example, you know here on a cross like this, well, retail's going to puke faster than institutions are going to buy. What happens? And if you're in the Alpha Chasers community, you know this because this is where we closed all those tech swing trades. It was on February 21st when we got out of that stuff. And it wasn't because we knew this was coming, but we saw signs like, hey, we're going to get a lot of supply in here. Why do we want to be in this stuff? Let's get out of the way and figure out what's going to happen, and we'll find a better spot. I believe that spot has developed, and I'm going to get into that in this video. But it does tell us something where here, if you're completely full and then they start to buy, well, they're going to take their time getting out. And what are they going to do? Retail. They're just going to keep buying until they stop. And then what happens? And that's exactly what you saw even happen here. And you can see these areas of interest up here as well. So it's not a function of do we bottom, did we not bottom or not? It's a function of, hey, institutions have all of the supply up here that they've had for 3 years, as we talked about. And demand for retail is pretty far off on a spread basis. And we know that institutions are going to take their time selling. So the idea out there of, is this a bear market rally? Is it this? I don't care if you call it a blueberry. Let's say you are in a bear market rally. Let's just play devil's advocate because that'll make all the bears happy. It's a bear market rally. And it still goes in your face. Do you really care? All you care about is price. Bear market rallies are the best if you're long because you make a lot of money very fast. So I really don't, the slight that bears use, I'm going off on a tangent, but the slight that bears use, oh, this is only a bear market rally. That's what they sound like. It doesn't matter. I'd rather have a bear market rally because you make a fortune in a very short period of time because of the volatility. But I don't believe that for a moment, but it doesn't really matter what I believe or they believe. All that matters is that we look at this stuff, use it to the best of our ability, and make money. Let's dive. Now, in this part, what they do a great job of is just breaking it down. So here's 5 years. And in those 5 years, you can see us right here. And here we are again. And in 5 years, has retail ever been here before? Yeah, it has, and it's been right here. And so what a lot of people will do is they'll go, oh, well, we have to double dip. Again, I'm not going to draw the stool, but please understand, from here to here, you were fighting the Fed. Meaning, they always say, don't fight the Fed. Don't fight the Fed. When they're selling trillions of dollars of assets against us, you don't want to fight them. And that's exactly what they were doing. This is why all our readings were skewed. That's why all your readings were skewed up here too. Because they're literally buying everything. The Fed was buying everything in here. That's why it's so tight. They bought every single dip. And that's why housing got so out of whack. I'm not going to go through the whole thing, but you're fighting the Fed in here when they're deciding that they want to sell. It's literally this inflection point. If you go back and look at when Powell said we're going to sell assets. So of course you have to look at order flow, but you also have to overlay the macro and am I fighting the Fed or not? You're not fighting the Fed here. Quite the opposite. They slowed down dramatically in what they're selling. He actually came out and said that, I believe, 2 meetings ago. And if we look at where we're at on a 5-year, you're coming off one of the greatest drops that you've had in 5 years in dumb money or retail confidence, because we should refer to it as confidence because they're putting their money where their mouth is. And we've had one of the strongest moves up. And then we know up here, we have the most supply that we've had owned by institutions in the past 5 years. Hopefully you can see where this is going. And we just take a sec, zoom in on this on a 3-year. You're starting to see these areas of interest. And again, back here you can see it. For me, I love divergences like this, but nevertheless, the divergences are awesome. But do I need one? I don't, but I had one here too. And you can see that you're right here. But do I have some kind of divergence? No, not really. And I'm not sure when you're at zeroed out down here and everyone's puked out their guts that you're going to get a divergence. Could you? Yeah. I mean, you even have mini ones in here, if you think about it, where you have this low and then you have a higher low and then you're at the same area. You start to have them there. And you see this as well, I'm sure, where you have this low and then the higher low and then this and here. So I'm sure you saw these divergences just by looking at it. Do I need one here? I don't think so. Could it sell back down because of a mean tweet? I don't think so. I think we're past the mean tweet because of the VIX. And we'll get that. The mean tweet syndrome is probably what we should call it. I think we saw what happened on Friday. It presented a buying opportunity. We're going to go over that. Again, this is Sentiment Trader. This is not mine. But I do think it's important to get this, to really understand what you're looking at here and why this can be so violent. And this is going to become important when we start talking about the breadth thrust, which we're going to. But when we start to see this kind of thing here, that's very important. When you flip like that and you run that fast, that is a massive amount of money coming in a very fast period of time. And you can see this through up volume and total volume. I could show you how to do that before the breadth thrust. The more that I think about it, I think that's a great idea. But please understand that this is the lowest readings that you've had versus where smart money is in 5 years. And they're violently buying. Do with that what you will. Now in front of us is the New York Composite. And before you comment, I'm aware that this is flipped on this chart. I have to just reset this to the difference and move with the data. And what's important about this is we're just going to do the basic. This red bar means you had more selling. A green bar means you have more buying. This is reflective in up volume versus down volume, advancing versus declining issues. These things that you'll hear a lot of. And that can lead to when we're looking at an indicator like we're about to go look at, which is a breadth thrust indicator, which will very clearly tell you what happened over a longer period of time. And we're going to get into that. But what I want you to get is how the easiest way to calculate these percentages that you're seeing out there when someone will say 90% day or something like that. So I just do it this way. And there's another step to it, but this is going to get you there. So you just take the up volume. And after you take the up volume, then you just take total volume and you just divide the two. And then you hit the button. And then you get your little data spot. And then you just convert to a line. And what this is going to do for you is it's going to give you these extreme readings. Now, what some people want to do is just take the up volume and then out of the total volume, then they're going to subtract the down volume and go from there. I don't even want to do the extra step. It's super simple. And you can actually see where you're at here, and it just gives me my reading. So when we're looking at what's going on and I'm saying, hey, maybe you bottomed, maybe you didn't. If you have up volume like this, an advanced decline like this, and you're not paying attention to it and think that you might have bottomed, you're doing yourself a disservice. What's crazy about this to me is this 90% level is here. So if you go back in time, and we're not going to do this, but if you looked at all these periods in time, where you were at a 90% up volume, like here in March, which is obviously the pandemic, or back here in October 22, which was the bottom of the market. If you went back here and looked at Trump 2.0 or 1.0, or if you went here and you looked at that August date and what happened in here for the bottom of the market, anything that gets you above 90% that you're not paying attention to, like here when Powell came out and said, hey, we're not going to cut rates or we're not going to raise rates anymore, they're all around these 90% levels. So when you're getting these, you want to pay attention to it. And the easiest way for me to just show you how to do this is up volume and divided by total volume. And this ties in to the New York Stock Exchange. So we're clear. That's where this data is coming from. Another way to look at this and to look at breadth, in my opinion, or a great way to do this is just to see where you're at, is to look at just advanced decline. And here's ADV divided by decline. Very simple. Just go and mark where you are. And then just, if you don't know what you're looking at, the easiest way to do this is just back test it. You go back and you're looking at this and going, well, we did this here on that Wednesday. And then from there, we did this August 22nd or 23rd, it looks like, on that Friday. And just go back through time and look at these spots on the market on the New York Stock Exchange, and then go from there and say, hey, what happened? That's all you really have to do with this data. You don't have to listen to anyone else. You don't have to listen to me say, hey, was this a point of interest? Is this where I should have bought? Or someone pontificating it. All you're doing is just going back and saying, hey, X happened, and because X happened in here, is this something I need to pay attention to? And that in and of itself is important, because what people don't understand is, like, you'll get these moves and they won't understand like why that move's significant. Like, no, we're up, you watch the undercut, and then it goes on and rips for months. They don't understand why that area is significant. But if you use some of those tools we just went over, you'll understand that. And I wanted to go over that, tie it to smart money, dumb money before we get into this breadth thrust that everybody's giddy about. Because I do like looking at these numbers and there is significance to it, but we didn't really trigger it. And so now what we have to look at is the significance of this. And I'll explain. Now, there has been a lot of talk about this Zweig breadth thrust. Did it fire? Did it not fire? The bottom line with this is you need to be under 40 and then above 61.5. And we're going to get into this in detail because it is important. It's very important because it does, in my opinion, it's been one of the most accurate things out there. But it didn't happen. And so if we measure from when we were under here, and people will say, well, it only has to happen from here over. If you took this low and you came to the top of it, you're going to see that that is 12 bars or 17. So it did not happen. You need 10 days for it to happen. If we took some subpar level like here, where you really weren't at 40% and we came over to it, you're going to see it happen in 6 bars. So for me, looking at it and saying, do you have a super technical one that triggered on all things? In other words, it either triggered or it didn't. And technically, it didn't. The question that you have to start looking at is, does it matter if it's 12 days or 11 days, which some people could argue because you were down lower, not as low, but lower. Does it matter if it's 12 days or 11 days or 10 days versus does it matter if you just got back to the 60% line and what's happened every time that we've gotten up to the 60% line? I think there's 2 different ways to look at this. And for me, what I think is most important is if I'm looking out on the period of time that I'm looking and then the index that I'm looking at, right? So what period of time does this matter to me? That's the first thing. What period of time does this matter to me? In other words, if I'm hitting it, does it matter to me that I'm looking at a year? If I'm hitting it, am I looking out a month? Am I looking at a week? That's how you have to look at this stuff. So there's a really good research piece on this, and we're going to dive into a little bit of it because I think it really explains a lot of how I would use this and how I am going to use this going forward. So on the super technical one, if we look at where we're at versus where we are, we didn't make it. You're off. And the question becomes is, does it matter? I think it does to an extent, but I also think that you want to look at the data. So for example, like from here, from January 23rd on, did it matter here? It definitely was significant. Did it matter here? It definitely was significant. So for me, it's these rate of change. Whether or not you're actually firing on all cylinders, there's a rate of change here. And so I just really want to hammer that home. The rate of change to me and the speed of the change is significant. Now, if you want to get super technical, this is exactly what it is. And I just grabbed this from Investopedia and you go there and read it yourself. It's a technical indicator, market momentum. So it's a momentum indicator divided by the total number of issues. So they take all the issues, advanced plus declining, and then generate a 10-day moving average on that percentage. So they're taking the advanced plus declining, and then they're generating a 10-day moving average, and then the speed of which that average moves, the change in which that average moves, generates the thrust. All right, that makes sense. Indicates signals potential bull market from a 40% to 61% any day period. This is a rarely occurring sentiment which carries tremendous importance with market watchers. It does. There's a couple reasons why it does. But for me to look at this and say, oh, it happened here and it happened, no, it doesn't work that way. I think the technical one, maybe 18 times since like 1945 or something like that. It's either 18 or 21 times. But what matters about it is what it's saying about the market. And is there something else that we can take from it? To me, there is. It's always important to me to understand where this data comes. This is where Martin Zweig lived just so you know it. So when you're listening to someone on Twitter and they're talking about the fact that don't pay attention to this, ask yourself if they lived like this. This guy came from nothing and lived at the top of the Pierre. So you'll start to see articles like this where don't be too bullish on there. Tom McClellan's coming out and saying, oh, it's done pretty well in the 80s, but this is a bear market and this is a counter trend rally. Is he right? Is he not right? You never know how this stuff's going to play out. The data substantially shows that there is something that you buy when this happens. And we're going to dive right in. So near misses on the Zweig breath thrust happen all the time. And this article that came out a year ago, it's kind of interesting because go look at what the market did since then. But what they're talking about is these runs and how they happen. The signal, here it is, only happened 18 times since 1945. And the most recent one was 11.3. I think that I think it's important. Why is it important? Or at 3/11/24. Why is it important? I hate when they write the dates. Following the previous 17 signals rose 12 months, 100% of the time, with a median gain of 22. S&P has gained 19%. Indicator, 10-day moving average, we went through this, and what happened? It went from 36 to 63. So technically it failed to qualify because it took more than 10 trading days. And what they're saying is, does it matter? And that's how we started this. So what they're doing here is he's saying, okay, let's get rid of one part of it and just say, if it crosses the 60% line, meaning the breadth switches that fast that crosses the 60% line, because we know it's a 10-day moving average, so it has to snap up in order to cross that 60%. What does that tell us? So what we do is we go back and we grab every single one of those spots and then we back test what has transpired over that period of time from 1962 to 2024 at the time of this article. This is what I thought was really interesting about it. Once you start looking at the data from when that fired, your percentages actually start going up after a month. In other words, your win rate on whether the market's higher or lower is 74%, 83%, 85%, 91%. And you've taken all those data points going back to 1962. Why this is important to me is because I look at every trade as a coin flip and I'm fighting for inches. I know everyone tells you they have an 85% win rate, okay. But the bottom line is, when you look at this stuff, the top traders in the world are skewed where they're like 61, 62%. So guys that trade for like Cohen at SAC Capital or whatever he calls it now, I think 0.72. Those guys, like their top guys are 61, 62%. So when you see this kind of stuff where you're skewed this much, anything that gives you an edge, you want to pay attention. So if they're telling you like, hey, your skew after this happens should be leaning this way, you want to follow that. In regards to the returns and the weeks later, I think that there's a lot of other macro stuff that can go into this. The win rate's the most appealing thing to me. The median that I would say that I find fascinating is you didn't have one period since 1962 when this happened that any time that you had a win rate and what your average was. So even if your win rate, here's your average. I mean, it's kind of crazy when you think about it. But wait, there's more. He goes back through 62 and takes 10-year snapshots so that you can actually see it in action from when it's hit, from where you were in 62, from where it's broken below that level and snap back up, so that you can see it over and over again. But what he's showing you really, and what his data did in the test that he did, was just that 1962, 63 level. When it fired in here, you got back over. And it doesn't happen often, despite what people think. I mean, it didn't happen again until 67, 68, and then you get your clusters in here. But when you start seeing these fire, if you're not paying attention to it, I think you're doing yourself a disservice. Now, in being completely transparent, I think it's important. This is 73 to 82, and you had super high inflation during that period of time. And these breadth thrusts, did they work? Yeah. Did they work as well as previously? No, they didn't. And you can see when that inflation starts creeping up, this gets much harder. So if you're of the camp that inflation is going to spike, and this is important to understand when you look at any piece of data. If you are of the camp like, hey, inflation's going to go through the roof, these tariffs are going to kill us, 7% inflation that we're going to wish for. Like if you're in that camp, then this might be something that doesn't interest you. But I'm not in that camp, but I'd be remiss if I didn't show you the data. So let's look at the most recent from this, which takes us to the 24th to the 21st. And then we can see these areas of interest up, pulls back, undercut, goes back up, undercut. So is it an all clear that you just buy? No, but it does mean that you are starting to see money come in the market. And whether you're looking from here on out, all this is telling us is the same thing over and over again. You're having interest. What I noticed in looking at this stuff, what I found the most fascinating was not just the 0.6 levels, But if I had an undercut, and then after that undercut, like a massive undercut, and then after that massive undercut, the shortest the distance there, which is actually the trigger, is the most interesting to me. Now, I haven't done this yet because I'm trying to have some free time, but going back and looking at this indicator firing over 15 days or 20 days, and then how that becomes dilutive. I don't want to go too much down the rabbit hole because you guys are probably on a treadmill listening to this. But where I'm going with it is, why 10 days? What if we did 12 days? What if we did 15 days? What if we did 20 days? How dilutive is this? I think that would be an interesting study, and I think we'll probably do that in a video and backtest this thing going back to 1945. But to me, if you're not paying attention to these undercuts and then what happens, even if they're not perfect, I think you're doing yourself a disservice. Now, this is probably the most important slide to me from this whole group. What he does is he takes the New York Stock Exchange Zweig breath thrust. I need more coffee. And what he does with it, this is like super, like to me this was so cool, because he's not making it the NASDAQ breath, right? Because like there is one of those, and you could go and make it the S&P one. No, it was all predicated upon the NASDAQ. But what he does here is he says, okay, from the NASDAQ 100, and we go all the way back here to the 80s. 85 is how far he goes back. And then he says, all right, if this fires above 60, what happens to the NASDAQ 100? I thought this was like a really smart way to look at it, because he's taking the same indicator and then he's overlaying that indicator onto different indexes versus taking that index and making the same indicator. I hope that makes sense. But when you see this, there were only 2 times, I think it was 140 times or 135 times, that it didn't work. 2 out of 140. Like that as an indicator it's insane. Okay, so if we take that data, this table summarizes the NASDAQ 100 performance from the New York Stock Exchange Zweig breath thrust, just getting over the 60% line. Look at your median returns. Look at what happens a year later. 98% of the time. And I have a real data set here. It's not like I have 12. I have 135. I think he tells me in a second here when I go through it. I forget. I have the slides lined up. After they're lined up, I just roll. So 64, 68, 75. Like we talked about the skew. If you're not looking at this and you're not as excited, I don't know what to do. I can't help you. But if I have a win rate like this, 98% win rate on 132 times and 2 negatives, and then I go, okay, well, what were the negatives? 03, 6. Okay, so that time period where you're coming off the dot-com bust and 9/11. All right, and then the great financial crisis, which if you're of the camp that we're going to have high inflation and that exists out there, then you might be looking at number 3 for you. I'm not in that camp. So this is why I'm very excited about this. And overlaying this with what the VIX is doing from a technical standpoint, it's very hard to not think that it's risk on again. So I got asked to start showing trades again and then the walkthroughs of them. I'm going to do this Tesla because I think it ties into exactly what you should be focused on, which is your risk on now. When you're risk on, whether it's a bear market or a bull market or whatever you want to call it, you want to move when you first see it. You don't want to wait to the tail end of it in case it is a bear market rally. I don't believe it is, but we'll go down that path. So here we had a very simple trade, and all we did with this trade was wait. And what we waited for was this 10 o'clock area. And we had Michigan consumer sentiment. So I didn't want to buy a thing before Michigan consumer sentiment. When Michigan consumer sentiment came out and we lifted and we broke over this range, it provided us a pretty nice opportunity to enter this trade. I'll show you all the times. And then when we started trading up, there's an area over here to the left, and I'll show you on another chart in a second. And I scaled out, and then we hit up here, and I trimmed very little. The purpose of me staying with this is I wanted to stay with it for the day. You'll see that in the timestamps I'm trying to show. But what I'm watching is I'm just watching these lower highs over and over again. And all it's doing is just hitting lower highs. That's all you're doing, higher lows. All we're doing is hitting these higher lows over and over again. So they keep stair-stepping us up, and they're not breaking. So there's very little for me to do until we get up here and we get hit with the mean tweet. And then as soon as we get mean tweeted, that was pretty much it. And then I'm looking at this going, okay, how far down am I going to go? And in 25 years of doing this, it's always something, right? There's always going to be that thing. From a swing trade perspective, yeah, I still have like a long-term position from this position that I was trying to hold maybe over the weekend. When you start seeing stuff like this, it starts making you think a little bit. And obviously that was enough to make me wonder, like, hey, are we going to drop down? Or are they going to sell down towards the end of the day because of the comment about China and the tariffs? But we can look at this a couple different ways. First way we're going to look at it is just through the timestamps, because I just find it's easier to break them out this way instead of putting them on the graph. But this is when we're entering, and there's the 10:06 date. Why is this important? If you're just day trading it, my sense of that, if you're not trying to hold long term, you got to be scaling out into the push. And then when you're up $2-3, you don't know if you're going to roll back over. So you're scaling out into the pushes. I'll show you this on a chart in a second. But then as we get to those areas of interest or even strike prices on a Friday, I'll start to pull something out. Usually people say, how much do you trim? My first trim is usually 20-25%. I just don't even think about it. It's somewhere in that area for those that are asking. And then we're just watching it hit those levels. And why do I want to hold there? I'm just watching it get to these strikes over and over again and then watching how it acts there. And it's moving so fast that you know that they're stuck and you know the shorts are stuck. But what I'm doing is I'm moving off key levels that are on a daily chart and a 4-hour chart so that you can do this for yourself. And then we're up 11 and then I'm trimming very little into this. I want to trim something, but I want to trim very little because to me, once you're over this April 9th area, and people have heard me talk about this over and over again, that's telling you everything you need to know. Matter of fact, the only names you should be looking at are over that April 9th area. And then as we're lifting, I'm getting tighter and tighter with it. But what I want to do is I want to watch how we act at these key levels. And we're acting great. Like you probably were going to keep pushing candidly if we didn't get mean tweeted. And this was like me, old man, like yelling at the cloud. Saying, stop telling the market what it's going to do, because I kept seeing people in the community, they kept pulling money out of ideas. There's nothing wrong with that, but you have to read the room. You have to read the tape. If the risk on shifts, and that's why I just spent 20 minutes going through the shift that you're seeing in the breadth of the market, the strategies that you used in February to now are not going to work the same way. Same way as the strategies you used 6 months ago, they're not going to work, right? You adapt or die. So instead of doing anything, we just have this cloud that I have tied to volatility. Essentially, it does tie to EMAs too, but it's also tied to volatility, which makes it a little better. Actually makes it a lot better. And so what we're doing is we're watching that, and I'm just using the color coding as a guide. And then eventually I get mean tweeted and I blow it out. And this is a really good time for me to talk about an event-driven risk, which I don't think a lot of people are getting. You had risk at 10 o'clock with Michigan consumer sentiment. And if you're not looking at the macro picture of this market right now, you're not paying attention to the data or how tariffs are going, you're doing yourself a disservice. If you're just looking at the chart and say, when the chart says this, I'm going to do this, you're doing yourself a huge disservice now. You need to look at that. You need to look at the macro, the fundamentals, and then the when on the technical would have been way more better and prophetic if it worked when I needed it to. You want to focus on this and pay attention to this like a hawk, because what this will do for you is this will set you up for success, because you'll know what matters and what doesn't matter. Michigan consumer sentiment came out better than expected. As soon as that happened, it was risk on. So we know when risk on, you already know the breadth of the market, but then you know risk on top of that. That's when you start putting your trades on. That's when you lever your bets, because now the risk is over. I'm just using these levers on where we're acting as key points on the technical leg of the stool that allows me to start figuring out where I want to start getting out of the trade. And then I just got mean tweeted. And then my thought process there is, besides flipping a couple other key indicators up here, which I could do a whole video on actually. If you want more detail on this trade, actually comment below, because I can do it on this one pretty easily. What's important about this is I don't know what's going to happen here. I just know that we're starting to make lower lows for the first time, which have not been happening until then. And I also know that I'm going into that 2 o'clock level, which is when institutions start to move. So I get a lot of comments on starting to do these again, these kinds of breakdowns. If it's of interest, keep the comments coming and I'll keep doing. And you should. Now, reviewing those trades, I have zero problem doing. I think that doing more educational stuff like that is extremely helpful. You can see where you're at here, where Tesla's sitting right at that 200-day, and people are going to be like, well, are we going to reject? Are we not going to reject? Here's the bottom line. Nobody knows. I will say this. I do think that if you look at something along these lines with Tesla and the fact that you're back above that 55 and we see this volume, this is something we've been picking at for a long time, starting in the beginning of April, just because these valuations got silly. And I do believe in barbelling, meaning starting to scale into stuff when these valuations got silly, just in case it gets any more silly. But if you look at the 55, and I use a 55, some people use a 50, you should use what you're comfortable with. I go back and say, all right, well, the last time that earnings was this bad was like July. And so we look at this break that happened back here in July, and that led to a huge run in that. And people say, well, that can't happen again. Well, I don't know that. I don't know that that can't happen again. So when I start looking at data points like this, what I always look for is anything that's commonality. So if I go here and I measure from here down and go, well, that was about a 60% withdrawal from that area. And yeah, that was a pandemic, but that was about a 60% withdrawal. And then from that withdrawal over, it took how long before we finally got back up there? And this is what people are starting to forget a little bit. So we're going to remind them. It took you about 180 bars or 80 trading days or about 115 days to get there. If we start flipping like this again, and if he goes back to the company and if he runs things the right way, where are we in 100 days? Are we back to this level? So people will say, well, that can't possibly happen. Well, how many times has it happened in the past? How many times have we broken down, taken out lows, broken down, taken out lows? And then how long before we came back from those and then got to that level? Well, here's another one, and that took 277 days. So can this happen? Yeah. Do you have drawdowns like this in Tesla? Here's a 40% one when it was dead and no one was ever going to buy it again. But this time it's different, right? This time it's not going to do that because everybody knows. See where I'm going with this? You have to start looking at this stuff when you see these drawdowns like this. Oh, look, a 46% drawdown. I'm sure it's dead. I'm sure it's never getting back to that high again that it was just at. How long did that take? That took 200 days. But again, as always, this time it's different and it's dead and it's never going back. I make fun of it from a standpoint of, we're all going to be driving, our juicer around, but, we're all going to have a humanoid robot. But when you see these kinds of drawdowns from these levels, and then we hear that this time it's different, this time it's really going to break, and then you go back and look at history and go, I don't know, we've only done it, we've only hit it on this chart alone over the past 5 years, you've only done it once, 3 times, right? And that's not even counting the minor ones where you're doing it 4, 5, 6 times in 4 years. I don't know, maybe you want to try to catch one of those instead of telling it that it's broken. And I'm all for being short names, but what I'm saying is when you start seeing signs of, hey, we're getting buying, hey, we're getting institutional sponsorship, and remind yourselves, that's how I look at the 55, institutional sponsorship. It doesn't mean you have to run in guns a-blazing, but if you don't start looking at this stuff for what it is, you're going to miss some huge moves, in my opinion. Now, what you have to do and why I look at things and show you like, hey, this is this indicator. This is where this guy came from, where they're talking about this dumb death cross and the death cross and that's it. And ooh, you better get out of the market. What's happened? Here you are at 25% and you can see that. You're up 25% since everyone scared you with their death cross. All right. That's what's happening. You can either look at what's happening and take advantage of it, or you could look for a reason that it's wrong. It's up to you what you do. When you see something like this, you want to take advantage. To me, looking at institutional support starting to curl up and hold after a period where it was down, I think you're remiss in not looking at something like that. That's why I bring this stuff to your attention. And that's why I talk about things like, hey, who says that death cross? What happens in a year from a death? See, when you start thinking about this stuff for what it truly is, it starts painting a very different picture. People will go back to 21 and say, well, it was bad in 21. Everything was bad in 21. The government was selling $1.7 trillion against us. Like, they were literally selling assets to the American people. Like, yeah, that's going to be a really bad time, but that's not what's happening. So it becomes a function of context, and that's really important for you to understand. I can't stress that enough. You have to look at the context in which this stuff is happening. What I would refer to and what I think you should be focused on is any asset class that is above its peak VWAP. And if you're not using that as a guide, then you're going to wind up missing a lot of these names. There's a reason, and people that are in the community know that. There's a reason. Also, if you are on the wait list, the last batch for 12 hours is going to go out today, and then it will be closed for a period of time for those that are looking for a letter. If you look at something like this, well, we got above the 55. Oh, well, this time it's different because of this and that, and this is what's going to happen. Okay. Because it didn't work this time. And what I say is you want to use these as demarcation. Are there times where these flips matter? Yeah. But if you're using this stuff for demarcation lines, it's putting you in the right spot to take advantage of what's happened. And I think that's what you have to focus on. So when I look at something like MSTR, I'm thrilled at what it's doing because we've been in this. We actually started trading around in this like 260 bouncing off the 200. But the swing that we did was right in this area and we didn't really falter on it. We took a little out, but this is what you want to pay attention to. We're back above the peak VWAP. And that tells me everything. And this is how I view things. I view things as demarcation. So I look at this and say, oh, look, we're back above here. All right, cool. Let's see where we are. Let's see the left, and let's see what we can do with. Now, what do we do? 408, okay? Everything is context. Everything that you're doing is context. So the people that are out there that are telling you AI is over, AI is the end, Where are you? Where are you on the week? All right, well, Now's up 21%, VRT's up 20%, GEV's up 14%. Google, which just came in line, is up 6%, and DLR is a REIT that does AI that's up. So every single one of these companies had nothing but positive news and guidance reaffirming, if not raising guidance about AI data center. But everyone out there is telling you that data centers are dead. So you can either do your own work, or you can listen to everybody else, or you can find people that are actually doing this stuff for real and listen to them. Whether it's me or somebody else, it doesn't matter. But getting the information the right way makes all the difference in the world. My sense of this and what's happened with uranium and why I wanted to bring it up, because I still think I'm a little early here, and you can see how you're sitting right at this level. When we're getting more risk on, and if you don't think you're getting more risk on, all you have to do is just watch gold. And I still think gold's going to be hot because of the uncertainty that comes with the market. But as we get more risk on, I think it's fascinating that we look at uranium, we watch that OKLO actually lost Altman as he went to another company as they talk about this merger, and the stock went up. That tells me that something's going on in the uranium space, and that's why it's on my radar.